There's been a lot of mortgage talk lately. The 50-year idea is getting attention, and there's talk about letting owners keep their rate when they move. Let's clear the noise. I'll show you what each path means, what actually exists today, and how to choose with a simple model. Hi, I'm Jeffrey Hoffmann, and I help buyers across the Hudson Valley region. Start with the baseline, the 30-year fixed. Payments are predictable, the amortization curve is reasonable, equity builds at a normal pace. It's simple to plan around. For many people, this is still the cleanest path. What if 50-year term changes? Extending the term lowers the monthly a bit because the same balance spreads across more payments. But the trade-off is that it raises total interest paid over time and slows equity build. If you hold the loan for many years, the long-run cost is much higher. If you plan to sell or refinance earlier, you're gambling on future conditions you don't control. Lenders can also price long terms differently, and program eligibility would matter. The idea of keeping your rate when you move is often called portability in other countries. You sell one home, buy another, and carry your old rate forward on the new loan amount, usually with limits and time frames. In theory, portability reduces the lock-in effect that keeps owners from listing. In practice, lenders may price that flexibility into rates up front, limit how much you can port, and set rules around timelines and property type. If portability ever rolls out at scale, expect rules, paperwork, and a clear definition of who qualifies. So what exists today in the United States? Some loans are assumable, most commonly FHA and VA. A qualified buyer can take over the seller's existing loan and its rate, subject to approval and program rules. It's not portability because the loan doesn't follow you to your next home, but it's a real path in specific cases. Assumptions add process time, and you have to cover the gap between the purchase price and the remaining loan balance. That takes me to the pros and cons. 30-year fixed, stronger equity build, simple planning, widely available. The 50-year idea, lower monthly now, but slower equity, much higher lifetime interest, availability and pricing is unknown. Portability concept could reduce lock-in for movers, but lenders may price it in and will add rules not available here today at scale. Assumable loans, real for FHA and VA, powerful when the existing rate is much lower, but you have to qualify and cover the equity gap, all with a longer timeline. Here's how to choose for your situation. Use a side-by-side model with your lender. Ask for 2 printouts and a baseline. Printout A, a standard 30-year fixed that fits your budget. Printout B, the alternative you're evaluating. That could be a 50-year scenario if one becomes available, or an assumption analysis if you're looking at an FHA or a VA listing. Baseline, the same purchase with no lever, so you have a clean comparison. Look at monthly and cash to close side by side, then add a quick hold period note. If you'll likely move again in 7 years, ask how each option looks at the 7-year mark. Stress test your choice. Ask the lender to show the payment if rates move 1% higher than you expect or 1% lower. Confirm any prepayment rules or portability deadlines if those ever become available. This takes 5 minutes and it removes guesswork. Who tends to benefit from each path? 30-year fixed, buyers who want simplicity, faster equity build, and long-term planning without surprises. 50-year, buyers who absolutely need the monthly relief now and understand the long-term cost, or who expect a shorter hold period and accept the risk. The portability concept, move up or move down buyers who would list if they could keep their old rate, subject to the rules that would exist. Assumable loans, buyers who can qualify and cover the gap, and sellers who hold an assumable loan with a much lower rate that could attract more attention. The move I would make today. If you're shopping right now, I'd price a 30-year fixed as my baseline. Then model one alternative with the 2-scenario worksheet. If an assumable loan is in play, include the gap in the cash line and plan extra time on the calendar. The clearer the model, the calmer the decision. If you want the template that makes your lender ask simple, download the 2-scenario worksheet and send it with your request to your lender for printouts. The link is below.